So, how do taxes influence physical gold prices? Well, let's actually take a look at some taxes being charged on gold in various different countries. So, in Canada, there is a 50% capital gains tax. In the US, is 28%. In Ireland, 25%. In India, there's pretty much a total of 27%. All goes out in taxes. Spain got 20% on VAT when selling. In the UK, there is 18% capital gains tax, which it's important to note that it only applies to foreign bullion. So the actual coins from the Royal Mint or bars, their capital gains tax free. China got 17% VAT, although that's only charged on standard gold traded outside of the Shanghai Gold Exchange, and also imported jewelry also has a 17% tax, VAT tax. Italy is 12.5% value-added tax. France is 10.5%, although after 22 years of possession of that gold, there is a total exemption from tax. In Japan, we got 10% consumption tax, which is paid at customs. Although interestingly, gold from Hong Kong, for example, you don't have to pay consumption tax for that if you bring gold to Japan from Hong Kong. So it's a very, very strange situation over there. And all these other countries, there is absolutely no taxes when buying or when selling. Now, in general, the general rule of thumb is when taxes are high, there's obviously less demand, because obviously buyers are disincentivized from buying, and obviously that leads to a decrease in physical gold prices. Dealers bring prices down, there's more discounts, things like that. When taxes are low, there's moderate demand, so that usually causes physical gold prices to fluctuate a bit, but not too much. I would say that it actually is a bit stable. There is not a huge change. I mean, the fluctuations are not sharp, basically. That's what I'm trying to say. When there's no tax at all, there's obviously going to be higher demand, as people have no barriers to enter the market, and obviously gold prices will surge in that situation. Now, the issue is, if this rule of thumb is, functional, if it works, if it plays out in reality, then you would expect in countries such as US, India, Ireland, you'll expect lower gold consumption, and in countries such as Germany, you'll expect pretty high consumption, right? Because in Germany, for example, there is no barrier to entry, but in the US there is, or I should say, barrier to exit. So let's actually take a look at the graph here. to explain why this rule of thumb might not hold in some circumstances. So if you look at this chart here, so we can see that gold consumption is really high in countries such as China, India, United States, Germany. Obviously, we saw earlier that the taxes when selling gold in India and China and the United States were quite high. So if it's high and the consumption is still high, then why is that the case? Why isn't it lower? Shouldn't the tax, disincentivize buyers? Shouldn't that decrease demand? Well, the thing is, the reason why this is happening is because obviously China and India have a very large population. As you can see, China has 1.4 billion people. India has 1.3. So naturally, the demand for gold is going to be higher just because there is more people. There's also a cultural aspect to it. For example, in India, gold is quite important for weddings, and of course in China there is a long tradition of saving, just protecting your savings, and gold is quite important over there as well. So combining all these factors results in high consumption of gold, high demand, despite relatively high taxes in those countries. So yeah. And also just want to show something. Not only that, but also countries which suffer from geopolitical risk. So countries like Saudi Arabia, Iran, Russia, Turkey. Basically, a lot of these countries at the bottom, they are affected by geopolitical risk, and obviously gold is a hedge against geopolitical risk. So even if there is relatively high taxes, that also helps the geopolitical risk causes the consumption to be higher as well. However, if we look at the second chart, so that shows the country's national wealth, we could say GDP, and gold consumed per capita, per head, per person. So as you can see, Germany and Switzerland have the highest gold consumption per capita. And very interestingly, that kind of explains why in Germany and Switzerland there's absolutely no taxes when buying and selling, because gold is being consumed at such a high rate and is such a important investment, it appears to be, in those countries. And so that's actually an important part of their economy. It's important for the households that are located there. It's important for banks. A lot of, like, Germany has the highest reserves of gold, for example, and Switzerland. And Switzerland is even a country where a lot of gold is kept in vaults, being protected. A lot of other countries' gold is even there, deposited there. So again, that clearly explains why there is no taxes there, because it's economically beneficial for them. So there's no tax, but obviously the result of no tax is higher demand, higher gold prices. Well, higher demand is also another way of saying high consumption, high need for consumption, and we see that in Germany and Switzerland in that graph. So to conclude, this is a general rule of thumb, it's a heuristic, and it in general it holds. The only in general it holds if you isolate like cultural aspects, traditions, geopolitical stuff. If you isolate those two, then it will hold. But if you factor in all these variables, then that actually breaks down the rule of thumb a little bit.